Hey, what is going on, guys? My name is Nick, and in today's video, I'll be sharing 3 ETFs that are down big with the market sell-off that I believe have the potential for a huge rebound once the market recovers. Now, you all know I'm a huge fan of buying into growth stocks, but I also believe it can be super beneficial for investors to buy and hold into ETFs to mitigate their risk while taking advantage of these fast-growing industries. Right now, my investing strategy is to double down on growth stocks and growth ETFs while the prices are cheap, so that when the recovery does happen, and it will eventually, I'll have gotten in at extremely low prices and I'll see outsized gains. So anyways, please remember to hit the like button to help support my channel and all the research that went into this video. And if you have not already, please consider subscribing so you don't miss any of my future uploads. I'm uploading like crazy right now because I'm fired up, so let's get into it. Now, the first ETF to buy on the dip today is the Prime Mobile Payments ETF with ticker symbol iPay. iPay is the first ETF to target the mobile payments industry, which has been growing quite rapidly the past decade and should only continue with the increased push towards e-commerce and online spending globally. Up until recently, the past 5 years have been incredible in terms of iPay's performance, where it beat the S&P 500 returns by quite a large margin. But over the past year, it's been underperforming quite a bit, being down over 35%, and the entire payments sector sold off amid the slowdown in e-commerce activity as the economy reopened, and now the Russia and Ukraine situation caused even more uncertainty. Now, here's why I believe iPay has the potential to start outperforming the market once again very soon. Firstly, the online payments industry is expected to grow at a compounded annual growth rate of 12.8% for the next 5 years at least. Here we can see the total digital payments worldwide in 2021 totaled $7.4 trillion of transactions, while that number is expected to nearly double by 2026 to $13.8 trillion. There are so many drivers for the online payments industry, such as online advertising, e-commerce, social media, so honestly, I believe this industry will continue growing for decades to come. And iPay is positioned perfectly to take full advantage of this growth since it owns some of the most profitable and the biggest payment processors in the world. For example, American Express is the largest position at a nearly 8% weight, then Visa and MasterCard each at 7% weights, Block, aka Square, is weighted at nearly 6%, and then PayPal at nearly 4% of the ETF. Secondly, we can see that anytime iPay ETF has dipped in the past, this has been a great buying opportunity, and it's almost always outperformed the S&P 500. For example, iPay rebounded 123% from the March 2020 lows within a single year, and it had a very strong comeback from the early 2019 lows too. So because iPay has a relatively high beta, meaning that it's more volatile than the S&P 500, these low prices could mean that the eventual reversal will be very strong in the stock price. Thirdly, with the digital payments industry becoming increasingly competitive, I believe iPay ETF offers a safe haven for investors wanting to get into this growth, but also diversify because this ETF does hold 53 different stocks. And of course, any big new competition that does emerge within this industry will be reflected in the ETF if it does happen at some point in the future. So basically, you're taking full advantage of this industry's growth and you don't have to worry about competition impacting your returns. As for fees, iPay has a management expense ratio, or MER, of 0.75%, which means you'd only end up paying $75 per year in fees for every $10,000 invested, which really isn't too bad. Overall, guys, I absolutely love the fact that iPay is down 35% from its highs, which has rarely been seen in history in such a high growth and secure industry. So I believe that this could see very outsized returns when the market sentiment returns. Now, the second ETF to buy on the dip is one that you've likely never heard of, and that would be the CraneShares Global Carbon Strategy ETF with ticker symbol KRBN. Unlike a normal ETF, Carbon doesn't actually track any companies or industries. Instead, it's an ETF that tracks the IHS Markit's Global Carbon Index, which is essentially the weighted average price of a carbon credit worldwide. Now, just bear with me as I give you a bit of background because this is very important. As the world transitions to net zero carbon emissions, one of the best strategies to accelerate the adoption of clean energy is through what's called cap and trade carbon credit programs. These programs require companies to buy or sell carbon credits depending on the amount of GHG emissions they generate annually. For example, Tesla will receive carbon credits for free since they manufacture EVs, so they'll sell their credits at a huge profit to other automakers that can't meet regulatory requirements. Now, what you need to know is that the world's biggest carbon credit cap and trade program is in the EU, called the Emissions Trading System, or ETS, where over 11,000 power plants and factories in the EU accounts for 41% of their GHG emissions. And each year, the EU reduces the total allowable amount of carbon credits, which means the value of each credit will continue rising due to supply and demand if companies can't conform to EU regulations. In fact, recently in 2021, EU member states adopted a new climate law where the new 2030 target for ETS emissions is -61% instead of the previous -43%, compared to 2005, requiring a 4.2% cut to total carbon credits each year. For this reason, carbon ETF rose super quickly in 2021 as the weighted average price of global carbon credits doubled from $25 to $50 per ton of CO2. But more recently, we can see that carbon credits dropped off a cliff amid the Russia and Ukraine situation, down to nearly $35 per ton of CO2, since investors thought the EU might relax their GHG emissions requirements for the time being. And since higher emissions generally leads to higher carbon credit prices, this would not be good for carbon ETF, which explains the sell-off. However, provided that the EU does not relax their emissions targets for 2022, this war in Ukraine could actually benefit carbon ETF. That's because countries are turning more aggressively to oil to account for a sudden drop in global supply and backfilling fuel needs with coal, therefore emissions are only expected to get worse. This other article also says, moreover, the regulatory framework of the market has not changed. Analysts still see a tight market on an annual basis, and there is still a robust 2030 climate target to drive long-term investment. However, there's still a lot of uncertainty right now, and higher oil prices could actually reduce overall economic activity because gas is so expensive, so we'll have to see where this goes, but long-term, carbon is an excellent ETF to own. As for fees, carbon has an MER of 0.78%, so it's a bit above the average, but honestly it's a very targeted ETF and you won't find anything like this, so it makes sense. Overall, in my opinion, government regulations surrounding carbon emissions will only get stricter into the future as the world transitions to clean energy. As a result, the allowance for carbon credits will continue decreasing over time, and therefore the price should increase because supply is being reduced, and that makes carbon a great investment in my own opinion. Alright, now moving on to our third ETF, this would have to be one of my personal favorites, and this is the Vanguard Information Technology ETF with ticker symbol VGT. Without a doubt, VGT has been one of the best performing ETFs in the entire world, and even after the recent sell-off in growth stocks, it has held up relatively well, only being down 20% from the highs in late December, while it's still up 5% over the past 1 year. Now, if we compare VGT to the overall S&P 500 returns, we can see that it has vastly outperformed over the past 5 years, being up 176%, while SPY is only up 77%. And that is because the top 10 holdings contain some of the best and biggest tech stocks that you'd know of, including names like Apple, Microsoft, Nvidia, Visa, MasterCard, Adobe, etc. But while there are a total of 360 stocks within this ETF, these top 10 holdings account for over 60% of the total ETF's weight. So if you don't like these top 10 companies, then obviously don't buy the ETF. Now, one of the first things you'll notice about VGT is that it's a Vanguard ETF, meaning that it has extremely low fees. Owning VGT will only cost you 0.1% per year, or only $10 for every $10,000 invested in this fund. So with the ever-growing demand for software, semiconductors, and technology in our digital age, VGT should continue to outperform the market, in my own opinion. Alright, now the fourth and final ETF we have here today is one with a little bit more risk but higher reward potential, and that would be the Roundhill Ball Metaverse ETF with ticker symbol METV. By the way, the ticker symbol used to be Meta for this ETF, but I believe the company Meta Platform stole this and they will be using it pretty soon, so just a heads up. Anyways, METV is the first ETF of its kind to track companies that are paving the way to the metaverse, which is expected to be the successor of the current way we use the internet. In the metaverse, almost anything will be possible. Going to virtual concerts, playing games with friends across the world, buying digital real estate and NFT art, the list goes on. In fact, Cathie Wood's ARK Research estimates revenue related to the metaverse could approach $400 billion by 2025, while Bloomberg Intelligence believes the market opportunity for the metaverse can reach $800 billion by 2024. So clearly it makes sense why companies like Meta and Apple are investing so aggressively into VR and AR technology to try and take advantage of this huge huge industry in the future. Now, unfortunately, ever since METV ETF was launched last June, it has done nothing but drop after the 2021 metaverse hype train derailed pretty quickly. But taking a look at its top 10 holdings, I believe this ETF has a very good chance at rebounding strongly once market sentiment does return. Since we have companies like Nvidia as the top holding at 9%, then Microsoft, Meta, Apple, Amazon, Unity Software, and Roblox, to name a few. And although there are a total of 45 holdings within the ETF, the top 10 account for about 50% of the total ETF's weight, which I like to see. Furthermore, based on the 7 key focus areas of this ETF, namely computing, networking, virtual platforms, interchange standards, payments, content, and hardware, METV ETF seems to be quite well diversified, which you'd want to see for such a new industry. Obviously, there are so many companies that can be tied to the metaverse, and many of which we probably already own in our portfolios, but METV ETF is a great way to concentrate a little bit more towards the metaverse specifically, and therefore take better advantage of its growth into the future. Finally, in terms of fees, METV ETF has an MER of 0.59%, which is a bit lower than it used to be and not too bad. Overall, I think this ETF offers some great exposure to companies that are tied to the metaverse, and based on all of the growth estimates for the metaverse revenue, this should do very well over the long term, and getting in early could provide some great gains. Anyways, the 4 ETFs that I believe are great buys on the dip are iPay, Carbon, VGT, and METV ETFs. But I would love to hear what you have to say down below. Let me know your favorite ETF and if you plan on buying any ETFs on the dip. But with that said, if you guys did enjoy the video, don't forget to smash the like button for the YouTube algorithm, and don't forget to subscribe so you don't miss any of my future uploads. And with that said, I will see you guys in the next one.